Are you dreaming of your first home? That exciting thought often comes with a side of questioning, where do I even begin? Buying your first home is a huge step, likely the biggest financial decision you'll make. And it's completely normal to feel overwhelmed. But don't worry, you're in the right place. Over my years of guiding hundreds of first-time homebuyers just like you through the process, I've learned the 10 essential steps to making your dream a reality. We've got a comprehensive guide ahead, but by the end of this video, you'll have a clear roadmap to confidently navigate your home buying journey. All right, let's dive into the very first crucial step, planning your finances. Think of this as building the strong foundation for your home ownership journey as a whole. Getting your financial house in order early on will not only make the process smoother, but also set you up for long-term financial success and peace of mind. This step really boils down to understanding 3 key areas: your savings, your income, and your credit score. When it comes to savings, we're talking about the money that you'll need to cover things like your down payment and your closing costs. Closing costs being the fees that are associated with obtaining your loan and completing the entire home purchase. Now, it's true that there are many different types of home loans out there, some even offering 0 down payment options, while others may require up to 20% or more. While these options do exist, I always encourage first-time buyers to aim for a solid down payment on the front end if possible. Generally speaking, the more you save up front, the better your financial footing will be in the long run, potentially even leading to lower monthly payments and better interest rates. As a helpful starting point, let's talk about the FHA loan for an example. This is a popular loan for first-time homebuyers because it often offers more flexible credit score and debt-to-income requirements, and typically requires a minimum down payment of just 3.5% of the home's purchase price. Now, while down payment assistance programs or these first-time homebuyer programs can be tempting, focusing on building your own savings will give you more control of the process and security in the long run. Now, it's really important to understand that the 3.5% down payment we talked about for an FHA loan does not include your closing costs. Think of the closing costs as the various administration and service fees involved in finalizing your mortgage and the purchase of your home as a whole. This can include things like fees for your title work, your appraisal, and various loan processing fees, as well as initial payments for things like your mortgage insurance or even homeowner's insurance. While closing costs can vary, a good rule of thumb is to budget an additional 3% of your home's purchase price to cover those items. So when you're planning your savings, aiming for a total of around 7 to 10% of the home's purchase price should put you in a much more comfortable position to cover both your down payment and those closing costs. Keep in mind that as the buyer, these closing costs are typically your responsibility as they cover the services that are directly benefiting you, the buyer, such as the appraisals and title work. While there might be rare situations where these closing costs can be negotiated with the seller, it's best on the front end to plan on covering them yourself. Now, if the thought of saving that amount of money feels daunting, please don't 100% get discouraged. I actually have several other videos on my channel that dive into some of the down payment assistance programs and even strategies for negotiating closing costs. So while aiming for this benchmark is a great best practice, there are some other avenues to explore, and I encourage you to check out those resources if saving this amount upfront feels challenging. Now let's talk about income, which is another really key piece of the puzzle when buying a home. Lenders want to see see a consistent and reliable income history, typically over the last 2-year period. Now, this doesn't necessarily mean that you've had to have the same job with the same employer for that entire time. What lenders are really looking for is evidence of stable employment and a steady stream of income. This usually means consistent hours if you're paid hourly, and ideally no significant gaps in your employment history. It's also important to note that if you haven't been in the traditional workforce for a full 2 years, that's often completely okay too. For example, time spent in school pursuing a degree or completing a trade program, including any required apprenticeships, can often be considered as part of that 2-year work history. The key is being able to demonstrate a clear path and the ability to consistently earn income. Ultimately, at the end of the day, lenders just want to feel confident that you'll be able to comfortably manage your mortgage payments. Now let's talk about your credit score, which is another really important piece of your financial foundation. Think of your credit score as a report card for how you've managed credit in the past, and lenders use it to assess the risk of lending you money. A great benchmark to aim for is a median credit score of 640 or higher. In the eyes of most lenders, this will generally be considered a good score. It's true that there are some loan options available even with a lower credit score than 640. However, it's important to keep in mind that if your score or a score of any other co-borrowers on the loan is lower than that, the lender may charge additional fees, offer a higher interest rate, or even require a larger down payment. So for those of you who want to really set yourself up for success and the best possible outcome, I highly recommend aiming for a median credit score of around 720 or higher. Your median score is essentially the middle score when you look at all 3 of your credit reports from Equifax, Experian, and TransUnion. Achieving a higher score like this is not only going to open you up to significantly more loan options, but it will also make you eligible for much more competitive interest rates, ultimately saving you tons of money over the life of your loan. All right, so if you've been following along and you feel like you're in a solid financial position to start your home buying journey, then it's time for step number 2, hiring your own real estate agent. This is absolutely a non-negotiable in my book, and here's why. You need an advocate on your side, especially when this is your first rodeo. Someone whose sole responsibility it is to represent your best interests as the buyer. Think of it this way. The seller of the home that you're interested in will likely have their own real estate agent that is working for them. That agent's sole loyalty lies with the seller, and their goal is to get the best possible price and terms for the seller. So if you were to contact that listing agent directly or work with them exclusively, you wouldn't have someone truly looking out for your needs and financial well-being. In fact, as the listing agent, their job is essentially to negotiate against you on behalf of the seller, potentially putting you at a large disadvantage. That's where a buyer's agent comes in. A buyer's agent works exclusively for you during your home buying journey. Their job is to understand your needs, to guide you through the entire process, and fiercely negotiate on your behalf to get you the best deal possible. Let's talk about the financial aspect of hiring a buyer's agent. Historically, it was common for the seller to offer a commission to the buyer's agent through the listing agreement, meaning it often came at no direct upfront cost to you as a buyer. However, due to recent changes in real estate practices, it's essential to understand that how buyer's agents are compensated is evolving. Moving forward, you will likely be asked to sign a buyer agency agreement with the agent you choose to work with before they start showing you homes. This agreement is now more critical than ever, as it clearly outlines the services your agent will provide and, importantly, how they will be compensated. This formalizes the agreement on fees in a changing landscape. This compensation is not set by law and it is always negotiable. It might be a percentage of the purchase price, it could be a flat fee, or another agreed upon structure. It's absolutely crucial to have an open and honest conversation with any potential buyer's agent up front about their compensation. Don't hesitate to ask how they potentially get paid and if there are situations where you, as the buyer, might be directly responsible for their fees. For example, if you're interested in a for sale by owner property where the seller may not be offering a buyer agent commission, or if the commission offered by the seller's agent is lower than what your agent typically charges, you might need to cover the difference. Keep in mind that in some situations, sellers might also offer concessions like credits at closing, which could potentially help offset these costs associated with a buyer's agent. I can remember being so scared to ask my realtor questions when I bought my first house before I got into real estate. I ended up at the closing table minutes away from getting the keys to my first property, still not even knowing exactly how she was going to be compensated and if I would receive like a separate invoice for her services. The recent changes to buyer agent commissions are really great in my book, as I truly believe that they open up channels of communication between buyers and their agents, providing greater transparency. When choosing a buyer's agent, look for someone who's not only experienced in working with first-time home buyers, but also deeply familiar with the neighborhoods and cities that you're looking in. First-time home buying can definitely have its own set of nuances, from understanding specific loan programs and grants to really needing more explanation on certain aspects of the process. A good agent will be patient, knowledgeable, and dedicated to guiding you every step of the way. Now, if this step of hiring a realtor already feels like a lot, please don't worry, I've done the groundwork for you. If you're ready to connect with a fantastic agent who is experienced in helping first-time home buyers and great at explaining things, you'll find a link in the description of this video below. Just take a moment to tell me about your buying timeline and where you're looking, and I'll personally ensure that you get connected with someone amazing. All right, you've got your financial house in order and you've found an amazing realtor to guide you. That's fantastic news. Now, step number 3 is to get pre-approved for a mortgage loan. This is a really crucial step because it essentially tells you how much a lender is willing to lend you, and it makes you a much more serious and attractive buyer to sellers. As we've already discussed, there are many different types of loans available, such as conventional, VA, FHA, and even USDA loans. A big misconception that I want to clear up is that you need to go to specific lenders for specific loan types. And in reality, most reputable mortgage lenders will offer a wide range of these common loan options. This is great news for you because the same lender can often provide you with quotes for options for conventional FHA, VA, and USDA loans, or whichever ones are applicable to you, allowing you to compare them side by side. So you might be thinking, where do you even start when looking for a lender? Since you've already connected with and hopefully hired a fantastic realtor, my first recommendation is to tap into their expertise. Ask your realtor if they have any lenders that they highly recommend, ones that they've worked with successfully and whose clients have been happy. Remember, it is completely illegal for realtors to receive any type of kickbacks for these recommendations, so you can trust that their suggestions are based on genuine positive experiences. This can be a really great shortcut to finding reliable lenders. Often these will be local lenders who are readily available by phone, and you might even be able to meet with them at their office, which can really help the transaction go smoothly. In addition to your realtor's recommendations, you can also ask your friends and family for referrals. Another excellent option is to potentially work with a mortgage broker. Think of a mortgage broker as the go-between who works with multiple lenders. They can take your financial information with an application and shop around with various lenders to give you a clear picture of different loan options available to you based on your income and credit score. Of course, you can also reach out to your local bank or credit union, as they often have competitive loan products. Finally, there are numerous large online lenders as well, offering another avenue to explore. It's absolutely vital, though, to shop around for a loan when you're buying a house, whether you're considering a local bank or an online lender. Typically, you'll need to fill out an application form, which the lender will use to assess your eligibility. To prepare for this, I'd advise you start gathering key financial documents, as lenders will generally want to see a month of recent pay stubs, your tax returns and W-2s or 1099s for the past 2 years, and your bank statements from the past 2 months. Part of getting pre-approved involves a hard credit check as well. It's essential for lenders to accurately determine your credit score, as this will directly impact the interest rates that they can offer you. But please understand that this hard inquiry will likely only cause a very, very small dip in your credit score, maybe up to 5 points. It's definitely not something that will significantly harm your credit. What's fantastic is that during this process, you'll have a 45-day window to effectively shop around. This means that you can have multiple lenders pull your credit and submit your applications to them within this time frame, and it'll be grouped all together as just one single hard inquiry on your credit report. This is a golden opportunity to compare the loan offers, the interest rates, and fees from different lenders. So definitely take advantage of it. All right, now for the part that many people find the most exciting. Step 4 is when you get to start house hunting. This is where your vision of homeownership really gets to become a tangible reality. But before you dive headfirst into scrolling online listings, my huge pro tip is to create a needs versus wants list. This simple exercise can be incredibly powerful in keeping you focused. Think carefully about your current family situation. How many vehicles do you have? If your family might grow while you live in this house, consider all of the non-negotiable needs, the number of bedrooms, bathrooms, location relative to work, school, or even accessibility features. Then create a separate list of your wants. Those features that would be nice to have, but aren't necessarily deal breakers, like a gourmet kitchen, a large backyard, or a specific architectural style like mid-century modern. Not only will this list be your guide when touring homes in person, but it also provides invaluable information to share with your realtor. They can then use it to narrow down your search and help guide you towards properties that are genuinely going to align with your priorities, saving you time and potential disappointment. It's so easy to get that pre-approval letter and then suddenly your eyes open wide. You feel like the entire housing market is open to you, like the world is your oyster. While that's exciting, it can also quickly become very overwhelming. You may not think it can, but trust me, I've been through this process and I've helped people through it. So having your needs versus wants list to refer back to will be absolutely critical in staying on track and making the right decision. Now, here's a key insight. If you and your realtor are truly on the same page, meaning that you've had a consultation up front, you've signed your buyer agency agreement, you've navigated the loan pre-approval, and you've clearly defined your needs versus wants, you've communicated them to your agent, you likely won't need to look at dozens of homes in order to find the perfect fit. In fact, I would suggest that if you feel the urge to look at 20 plus properties, that's something that you should do before you even seriously start this buying process. Go to open houses on your own time. Scroll on Zillow late at night when you can't fall asleep and get that initial curiosity out of your system. This may seem harsh, But it's coming from a good place, I promise. Because once you are in the buying mindset, this isn't just casual browsing or entertainment like you see online. This is about making sure you're locked in to make one of the biggest financial decisions of your life, or at least for the next several years. You need to be strategic and trust your realtor's guidance, which is based off of your clearly defined needs and wants list. Distracting yourself by looking at homes that just don't meet your criteria just because they might be aesthetically appealing can lead to confusion, wasted time. And remember, the goal is to find the right fit, not just any house. After exploring a few homes, you've likely found one that feels like a great fit and you're ready to make an offer. That's step number 5. Now, this is a really important stage where acting thoughtfully but also promptly is going to be key. In most markets, and even during slower times of the year, you'll likely find that there are other buyers interested in the same property as you. It's crucial not to wait too long to make a decision on whether or not you want to submit an offer. Even the seemingly small delay of going home to sleep on it for a night and reconvening in the morning could mean losing out on your dream home. The reality is that in the time it takes to think it over, another buyer may submit an offer that the seller accepts. So understand that time is of the essence when you found a home that you love and are considering making an offer. Lean on your realtor's expertise to help you gauge the situation and act decisively during this process. So you found the perfect house and you're ready to take the exciting step of making an offer. Understand that there are many different terms that can be included in this document beyond just the price. Things like contingencies, the closing date, what personal property can be included, can all be part of your offer. To keep this video from being an epic saga, just know that you'll rely heavily on your realtor for help to understand all of these terms and to expertly write up the offer for you. Once your offer is submitted to the seller, they will typically have around 24 hours to respond. They have 3 potential options when responding to you. First, they can accept your offer. This means that they agree to all of the terms exactly as you've written them. This is the best possible outcome. Second, they can reject your offer outright. They aren't obliged to even provide a reason. They simply just may not like the terms. If you receive a rejection, don't take it personally. It happens. It doesn't mean that they don't like you. It doesn't mean that you can't submit a new offer if you're still interested. So keep that top of mind. The third option is that they can counter your terms. This means that they're not completely on board with your initial offer. For example, they might agree to your price, but they might want a different closing date, or perhaps they're not willing to cover all of the closing costs you requested, or maybe they want to exclude a certain appliance. If you ever receive a counter offer, then you have the choice to accept their counter terms, reject them and move on, or even submit a whole new offer in response. If you've successfully come to terms with the seller, whether through an initial acceptance or after some negotiation, you've now reached step 6, the due diligence period. This is a crucial phase where you as the buyer have the opportunity to thoroughly investigate the property to ensure it meets your needs and expectations. During this time, you'll not only have the chance to conduct any necessary inspections, but also secure your homeowner's insurance. A general home inspection will likely be one of your primary out-of-pocket expenses during the entire home buying process. Typically, this ranges from anywhere from $400 to $500 and is payable on the day of inspection. The inspector will meticulously examine the entire house, from the crawl space to the attic and the roof, providing you what I like to call a comprehensive report card on the property's overall condition. It's important to understand that you are hiring this inspector to identify potential issues or items of note within your home. Forget the idea of a house passing or failing inspection. Instead, think of it as a detailed assessment. Here are some good areas that are in great shape, and here are the areas that might need attention, updating, or are in need of repair. This report empowers you with the information that you need to make informed decisions about moving forward. It's really important to understand that home inspectors are trained generalists. In fact, licensing requirements can vary by state, and in some states, a license isn't even required to be a home inspector. While they should have a good understanding of local building codes and can assess various systems, they aren't specialized professionals. So they aren't HVAC technicians, roofers, or foundation experts. Therefore, depending on the findings of your initial home inspection, you might choose to bring in these specialized professionals to get a more depth second opinion, all while still being in this due diligence period. In my market, this due diligence period typically lasts for 10 business days or 2 full weeks. Alongside the general home inspection, this is the time to conduct any other inspections that you may deem necessary, such as mold tests, air quality tests, or checks for lead or radon. This is your opportunity to investigate anything that concerns you about this property. So be sure to confirm the specific due diligence timeline in your area with your realtor, as it can vary. Additionally, this due diligence period is when you'll want to start gathering homeowners insurance quotes. Securing home insurance is not only crucial to protect your investment from potential damage or loss, but your lender is also going to require proof of insurance as a condition of getting a home loan. Getting quotes during this time allows you to ensure that you can obtain affordable homeowners insurance coverage for the property. Keep in mind that some properties might also require additional types of insurance depending on their location, such as flood insurance, especially if it's in a designated flood zone, fire insurance, particularly in areas prone to wildfires, or even hurricane or earthquake insurance. At the end of your due diligence period, you'll need to carefully review your inspection reports and determine how you want to proceed. This decision point leads us directly into step 7, which is potentially negotiating repairs based on the findings of your inspection. Now, assuming your home inspection revealed some items that might need attention, and unless you specifically brought the property as is, which means you agreed to purchase it in its condition currently, acknowledging any existing issues, you have the opportunity in step 7 to negotiate repairs with the seller. How I typically guide my clients through this process is by emphasizing that the items that are not functioning as intended are generally warranted to ask for in these repair negotiations. Think of that as a faucet that's leaking, or even an issue with the heating or cooling system to where it's not working properly. You'll even encounter a similar process if you decide to purchase a new construction home. In that case, it might be referred to as a punch list of items to be addressed before closing. Your realtor will be your key advisor in determining what's reasonable to request based on the inspection findings and local market practices. Once the seller receives your repair list, they will likely take a few days to review it and consider their options. In my market, they have 5 business days, which is essentially 1 full week, to review that list and respond to you. During this time, they will probably get their own quotes to assess the cost of the repairs that you are requesting. And at that point, their response will likely fall into one of 3 categories, similar to when you made your initial offer. First, they can accept your repair requests and agree to address all of the items on your list. Great outcome. Second, they can reject your repair list entirely and state that they will not be making any repairs. While this is less common if you didn't agree to an as-is purchase, it can happen. In this scenario, you would then need to decide how you would want to proceed, which could include trying to negotiate further or potentially walking away from the deal depending on your comfort level and the terms of your contract. The third and most common option is that they will counter your repair list. They might agree to fix certain items, like we agree to A, B, and C, but not others, like D. If you receive a counter, this opens up a period of further negotiation where you and the seller will go back and forth to see if you can reach a mutual agreement on the repairs. The goal here is to find a solution where both sides feel happy and comfortable and ready to move forward with the sale. Once those repairs have been agreed upon, we move on to step 8, which is the appraisal. Now, the appraisal is ordered by your lender, and while its primary purpose is to protect the investment, it also ultimately helps ensure that the property's value aligns with the loan amount that you are receiving. The bank will send out a licensed appraiser to provide their professional opinion of the home's fair market value. They won't lend you more money than the appraised value. So this step is absolutely crucial in the financing process. Think of it as the bank's way of confirming that the property is worth the amount of money that they're giving you. Much like repairs, the appraisal can have 3 potential outcomes. First, the house can appraise at your agreed upon sales price. For example, if you're under contract for $500,000 and the appraisal comes back at $500,000, that's a smooth and positive result. Second, the appraisal can come back with a value higher than your contract price. This is fantastic news. It means that you have potentially some built-in equity in your home right off the start. Depending on the difference in value, you might even be able to discuss potential options with your lender regarding closing costs or other aspects of your loan. The third possibility is that your appraisal comes back below your contract price. If this happens, it will likely require some more negotiations of the contract. Typically, responsible sellers will be willing to adjust the sales price to match the appraised value to keep the contract and transaction moving forward. Remember, in most cases, both parties, buyer and seller, want to see the sale go through. For example, if the house appraises for $5,000 less than your contract price, you and your agent can work with the seller to try and reach a new agreement. One very important thing to keep in mind about appraisals is that sometimes, depending on the property's condition and significantly your loan type, the appraiser might note specific repairs that need to be completed before closing. This is most commonly seen with your government-backed loans like VA and FHA loans, which have stricter health and safety standards. Think of it this way. For these type of loans, USDA, FHA, and VA, the property needs to be in generally good livable condition right off the bat. It's usually not the place for a major fixer-upper. For example, the home needs to have essential appliances like a working range for cooking. There can't be exposed holes in the drywall, and it needs to have proper floor coverings. Handrails on the stairs are also a common requirement. So if you're using an FHA loan and your appraisal comes back satisfactory in value, but notes that, let's say, a handrail needs to be installed on the stairs, the appraiser is going to include that in their report, and your agent will receive a copy, and this information will need to be sent to the seller. The seller will then be required to make this repair before closing. The appraiser then will need to return to the property to verify that the required work has been completed, giving the bank the all clear to fund your loan. So be aware that there might be additional repair items needed based on the appraisal, especially if the property has some condition issues or if you're using a government-backed loan. If you have specific questions about the appraisal repairs based on your situation, please feel free to ask in the comments below and I'll share my expertise. At this point, you've successfully navigated the inspections, negotiated repairs, and the appraisal is all clear. Now you're on the home stretch with step 9, the final walkthrough. This is your opportunity for one last look at the property, typically done within a day or two before your official closing. It's your chance to confirm that the house is still in the same condition that you expect and that no unexpected changes have occurred since you went under contract. Additionally, this is your opportunity to verify that any agreed upon repairs have been completed to your satisfaction. You have a few options for doing this. You can personally inspect the repairs yourself during this final walkthrough, or you can even request receipts or documentation from the seller as proof of the work being done. It's always a good idea to have your realtor include a clause when you're submitting your repair request list, stating that you want to see receipts if that is what you choose to do. Another option is to hire your home inspector to return to the property, often at a discounted rate, to specifically check the completed repairs for you. This final walkthrough is your last chance to ensure that everything is in order, that you're still excited about the property before you head to the closing table. Around the same time as your final walkthrough, you should receive your clear to close notification from your lender. This means that your loan is fully approved and that your paperwork is ready. They will also around this time be sending you your closing disclosure. Within real estate industry, it's referred to as a CD, and that'll come to you at least 3 days before your closing date. This document is extremely important as it contains all of the final details of your loan, including your interest rate, your loan amount, and the exact amount of money to the penny that you'll need to bring to closing. This CD leads us to the exciting final step, step 10, which is actually closing on your new home. At this point, it's absolutely crucial to carefully review your closing disclosure. This document outlines all of the final loan terms and costs. Make sure that all of the figures look correct prior to your closing date and that there are no surprises. If anything seems unexpected at this point, don't hesitate to reach out to your agent or your lender for clarification. Pay close attention to your cash to close figure. This is the total amount of money that you'll need to bring to closing, which typically covers your down payment, your closing costs, and prepaid items like your initial home insurance premiums, taxes, and any escrow deposits. Remember, do not show up to closing with a suitcase full of cash. That is not what cash to close means. You'll likely receive wiring instructions to send the funds to the title company or the attorney's office who will be handling your closing beforehand. If you're bringing a physical payment, it will need to be in the form of a cashier's check. Personal checks are not going to be accepted. Make sure that if you are bringing a cashier's check, that it's made out to the correct entity, which would be the closing attorney or the title company that will be handling your sale. On closing day, you'll need to ensure that you've either wired your funds or you have your cashier's check ready to go. You and any co-borrowers or spouse who's on the loan must be present at closing. Don't forget to bring a valid copy of your photo ID or driver's license as well. Typically, I'd say a closing for a buyer who's getting a home loan will take anywhere from 30 to 45 minutes. This is a great opportunity to ask any last-minute questions to the closer, your lender, your agent, who will all likely be there to support you. And that's it. By completing all of these steps, you will have officially bought your first home. Since I'm pretending to be your agent through the internet right now, I'd advise planning for a realistic time frame of around 3 to 6 months to navigate this entire process comfortably and not feel too rushed. While things can sometimes move faster or slower, giving yourself ample time will significantly reduce the stress. The same goes for having that extra cushion in your savings. Now that you have a solid understanding of the home buying process, if you're ready to take the next step and learn more about how much house you can realistically afford and how lenders are going to evaluate your finances to determine your loan amount, be sure to check out this video that I made explaining the debt to income ratio. I'll walk you through an example of what to look at in terms of your income, your debts, and how that's calculated so you can get a good idea of your loan approval likelihood upfront before even filling out applications. Thanks so much for watching. I'm Nicole Nark, real estate broker, helping you confidently learn how to buy, sell, build, and invest in real estate. I will see you in the next one.